Welcome to the Reinsurance Market Briefing, Rendezvous du Septembre 2020.
Well, good morning, good afternoon, or good evening, wherever you happen to be in the world. My name is Nick Charteris-Black, and it's my pleasure to welcome you to our annual reinsurance briefing. An event, of course, which would normally take place in Monaco on the first Sunday at this time. And hopefully some of you would have recognized the footage from last year's event. You may even have recognized yourself in the audience. And I know we have a number of people on today who would normally be joining us in Monaco. If I can start with introduce our presenters and panelists. Stefan Holtzberger, Senior Managing Director and Chief Rating Officer. Stefan is based in the US, although spent 5 years in London, so has good knowledge of the European reinsurance market. Greg Carter, Managing Director, Analytics, EMEA and Asia Pacific. Greg was also formerly in London with overall responsibility now for those two regions and based in Singapore. Anthony Diodato, Managing Director, Global Reinsurance Ratings, also has responsibility for our ratings in Latin America and based in the US. And Carlos Wanfupi, Senior Director, Global Reinsurance Ratings, also based in the US, having relocated from London. As you'd appreciate, our colleagues in the US have had quite an early start, but I'm sure they're going to be sprightly and particularly responsive to your questions when they come. Now, our comments today are principally based around a report we released about 10 days ago. So that's our annual reinsurance report. This year headed Global Reinsurers Maintain Equilibrium Through COVID-19 Turbulence. And as it says on the slide, it's freely available on ambest.com, or if the technology works, even by pointing your device at, at the code. Now, in that report, there are a number of articles, a number of other reports. I think there's 12 in all. So there is the lead article, there's our usual top 50 feature, and other reports and cover Lloyd's, mortgage reinsurance, cat bonds, life, and 4 regional segments covering LATAM, Asia Pacific, Sub-Saharan Africa, and MENA. So I think it represents the real breadth that AM Best has in terms of segments and geographical coverage of the market. Now, we do hope you'll participate in this webinar, as usual, through your questions. We always have a very lively audience in Monaco, and I hope today will be no different. If you do wish to ask a question, please email to webinars@ambest.com. So if you think you're likely to want to ask a question, I suggest you jot that down now, though it's not too difficult to remember, webinars@ambest.com. So I'm now going to hand over to Stefan. Stefan is going to make some opening remarks regarding our global reinsurance outlook. And then he will pass to Carlos, who will be leading us through the presentation followed by interjections by our other panelists. So with that, over to you, Stefan.
All right, thanks very much, Nick. And thank you to all the attendees today for taking time out of your busy schedules to join us. As Nick mentioned, we do really want to encourage questions. We have plenty to talk about today, but we certainly want to make this session really geared towards what you're most interested in. So by all means, send those questions in and we'll make this session as interactive as possible and address as many of those questions as we can. With that, why don't we jump into the outline here. So we've got 4 sections for the presentation today. We'll start with our market segment outlook on the reinsurance sector. And one important thing to bear in mind with our market segment outlooks, it's a little bit different than a rating outlook, where for a specific company or group, we're talking about the prospects of that credit rating over the next 1 to 3 years. And those outlooks can be positive, negative, or stable. Similarly, with our market segment outlooks, we also use the positive, negative, or stable demarcations, but here we're really talking about the market trends themselves and not so much the movement of individual company ratings within that market segment. Of course, there's a correlation because those companies have to compete in the market, but for our market segment outlooks, we're really focused on pricing trends, movements in terms and conditions, demand for reinsurance, the regulatory environment, as well as the capital in that market supporting the business. So from there, we'll move over to performance. And we'll talk about the performance over the past 5 years, focusing on that trend analysis. We'll look certainly at what we're seeing this year in 2020 under COVID-19, and what we see are the prospects for the segment over the near term beyond this year. From performance, we'll move on to capital. We'll look at capital both on an absolute as well as a risk-adjusted basis, and we'll spend some time differentiating between the traditional capital in the market and a topic we spend a lot of time on, alternative capital, and where that stands today, and that influence on the overall market dynamics as alternative capital ebbs and flows. Finally, we'll conclude with some more recent developments. We'll talk about the very active catastrophe season we're seeing so far in 2020. We'll talk about the trapped capital that's in the alternative market, and then certainly spend some time talking about the implications of COVID-19 on the sector. Next slide, please. That's great. Okay, so let's just jump right into the market segment outlook. We'll start with the challenges that the market faces, uncertainty on the potential COVID-19 related reinsurance losses from some specialty classes, whether it be travel insurance, event cancellation, some emergence in professional liability, E&O, D&O. There we certainly see some losses emerging, but many of the casualty lines will take much longer to materialize in terms of that claims development. So that we see as a headwind for the sector. The low yield investment conditions and capital markets volatility, underwriting discipline, and getting those underwriting rates really where they need to be is more critical than ever in this low rate environment. Less cushion in reserves, exacerbated by social inflation and, of course, property catastrophe reserve development. We hear the term social inflation thrown around quite regularly, but loss severity really has been on the rise over several years. There are more and more cases of the nuclear verdicts, particularly in the US markets. And as we're seeing, even property catastrophe can manifest itself as a long tail line of business with the loss creep that's come through. Global economic, less cushion in reserves, exacerbated by social inflation. I just mentioned that, pardon me. Global economic recessionary pressures and uncertainty of future demand for coverage. You know, here we see pressure on the top line driven by macro conditions. There's also the influence of societal changes that may come through as a result of COVID-19 that could alter the demand for insurance. And then finally, the uncertainty around government intervention. And, you know, really the question being, how active will governments be looking for a solution to future pandemics, or for that matter, addressing the current COVID-19 pandemic we find ourselves in. So if you can click one forward, we'll take a look at some of the supporting aspects of the market. And as you can see from the top here, we've maintained the market segment outlook at stable. And the reason for that, despite the headwinds and the challenges that we just indicated, we do feel that COVID-19 related losses will be manageable, and the demand for improved terms and conditions equating to more exclusions, more limitations on coverage, more in line with the rate being charged would be certainly a positive for the market. Accelerating pricing momentum at the primary level across many lines of business, many casualty lines, as well as loss-affected property. That will flow through to benefiting the reinsurance market, improving pricing across many reinsurance products. We saw that trend coming through ahead of COVID-19. So in 2019, we saw some positive momentum there, and that's certainly accelerated in 2020, and we feel that that will be continued into 2021. A flight to quality. Top-tier reinsurers are seen as an effective source of capital relief from the primary insurance market. So the top 20, top 25 reinsurers that we follow are benefiting from opportunities to grow their top line at better rates than they've seen in many years. And then finally, revised appetite from third-party capital, greater discipline from traditional insurers. You know, the traditional players are now more able to set the rates for property catastrophe treaties, and that will certainly continue to be a positive for the market. And so for those reasons, although it's a challenging market, we're not saying that there aren't difficulties in the market that the global reinsurance sector will face over the near term, but we do feel the market is well positioned to handle those challenges, and we're seeing a positive trend in some very meaningful aspects, such as the pricing environment and an adjustment for the terms and conditions that we're seeing in the market. So with that, I'll hand over to Carlos to cover the next section.
Thank you very much, Stefan. Yes, as Stefan was saying, and before we get into the specifics of the key performance indicators, we are keeping a stable outlook because we think that there are a number of positives and negatives that in some way offset each other. But to understand how we got here, probably we should try to look back at what our views were between 2014 and 2018, while we were keeping the market on a negative outlook. And let's remember, at the time, what we were seeing was excess capacity and overcapitalized market, both from traditional capital sources and from third-party capital. So this was obviously putting pressure on pricing, say very soft pricing conditions. And on top of that, a low interest rate environment. So companies really struggling to meet their cost of capital. So we've seen that decline in ROEs consistently over the years, and we'll illustrate that with a few numbers later. When we changed that outlook from negative to stable towards the end of 2018, it wasn't because we were terribly optimistic about the trends, or we were changing a significant change. Obviously, the loss activity had already started in 2017 with the US hurricanes. The ILS market had been tested for the first time, and we'll discuss later the issues about loss creep and trapped capital. But we saw some level of convergence between traditional capital and third-party capital, so some alignment in interests that we see it as positive. So we saw with this assignment of stable outlook a new normal, say the market having to get used to levels of performance which were probably below the historical levels that we were used to, but the market relatively stable. Now, during 2019, we start to see some early signs of improving pricing conditions. So these started both from the primary sector and the retrocessionary segment as well. So those early signs were discussed during in this venue last year. Unfortunately, so those expectations were crystallizing towards the renewals earlier this year. We think that this COVID crisis has simply exacerbated that. So the pricing has definitely something that was being seen as pricing improvements in single digits which some people consider disappointing at the beginning of the year, actually has accelerated quite rapidly towards the renewals in April, June, July, especially around Asian, Japanese risks and the Florida market. So with that, I would like to move to the next slide, please. So here, what we can see is the evolution of combined ratios, the performance, and the impact from positive loss reserve development as well. So first of all, let's think about the section before 2017. Say we were seeing these soft pricing conditions, margins really being eroded, and combined ratios going up until they reached this peak in 2017 with Harvey, Irma, and Maria. And after that, 2018, still a very active year in terms of cat losses, especially because of Japanese typhoons and California wildfires. 2019 reflects actually a number, say, reduced natural catastrophe activity, actually below the previous 10-year average, and a number of pricing actions, portfolio management, and adverse development covers that companies were buying. Now, at the same time, what we can see is the impact from these reserve releases. So despite the fact that the numbers don't look very good during that time, actually the performance based on an accident year is worse than what we can see here based on calendar years. So we can see that those reserve releases actually contributed between 6%, 4% in those years, but that ability to rely on previous year reserve releases has been diminishing over time. So at the moment, we have for 2019, that has reduced dramatically to around 1%. So the other point that I would like to mention as well, and especially in terms of the performance in the first half of this year, is that, yes, we have seen some improvement on the underlying attritional loss ratios. So there is definitely a reflection of that. In terms of the COVID impact, there is a wide range of estimates and say effects company by company. The loss ratio impact actually can be between 5% up to close to 20%. Say this is due, in some cases, for the largest companies, it's driven by lines of business such as event cancellation. Business interruption, as you know, is a significant issue, especially outside the US. And this is mainly reflected on IBNR reserves. So the case reserves are actually quite limited. But that wide range between the 5 and 20% that I was mentioning is a reflection not just of different business mixes, but also of different reserve approaches. So companies are being very, very careful on how they are reserving for this, and it's still early days, but say definitely this is adding uncertainty and pressure on the results that we are seeing. Okay.
Carlos, if I could just add one point on that slide. I think the amount of reserve releases in recent years has continued to surprise us. It's been a positive impact on underwriting results for many years. And I think ourselves and many observers have questioned how long that could go on for. And obviously, you can see here that the well is running dry at this point. And one of the reasons I think that it's explained why that's gone on for so long has been because of the impact of lower for longer interest rates and the impact that we've seen on inflation globally over recent years. We've moved into a much lower inflationary environment world, and I think that's benefited reserve releases over a longer period than would otherwise be expected. With that, the world running dry now, I think that may be an indication that people's longer term assumptions on inflation have adapted to that new normal, and people are expecting lower inflation rates, and so that extra margin in reserves may well have been competed away over time.
Yeah, thank you. You're right. I think that the numbers that we are seeing is actually it's the total net effect. We have there have been reserve releases. There has been reserve strengthening in certain areas as well. The social inflation comes to mind, and I believe that in any case, say 4 years to come, the situation is going to be a bit tighter because companies are getting a bit nervous about the uncertainty that COVID is adding to this. So I think that anybody is going to think twice before becoming a bit too aggressive about reserve releases, even if there were some grounds to try to release reserves. Okay. Thank you. Next slide, please. So first, and probably I should mention this earlier, the numbers that we are showing here are based on the top 25 largest reinsurance groups on a consolidated basis. So some of these may be impacted by primary business as well, or by life portfolios. Obviously, when we look at combined ratios, we are looking exclusively at non-life business. But just to clarify, so here we are looking at a similar picture, but by segment. See, on the one hand, we have the European Big Four, the US and Bermuda players, and the Lloyd's market. And there are a few differences that probably I would like to note. So first of all, the European Big Four being much more diversified groups, on the one hand, are showing relatively higher combined ratios, but they tend to be much more stable over time. In the case of Lloyd's and US and Bermuda, there's a bit more volatility. That is especially the case, say, with Lloyd's because of their capital structure. Yeah. The other thing to mention is that these differences are probably more pronounced when we look at the return on equity indicators, and this is because they show the impact of the investments and the life portfolio sides. In the case of the positive reserve development, what we can see is the European Big Four and Lloyd's are actually showing lower margins. So the curve has decreased more rapidly. Say partly this is because of a significant casualty component compared to other players. Final thing that I would like to mention is in the case of Lloyd's, say we have seen, and in the case actually of, say, most players, I mentioned the portfolio management actions that we had seen since 2019, and some impact from improving pricing conditions as well. So that in general has shown a relative improvement in combined ratios. In the case of Lloyd's, what we can see, especially for the first half of this year, is say that improvement has been material, although compared to the other two groups, expense ratios still are relatively higher. Say on average for the last 5 years, they are around 38-39% compared to other two groups, which are around 32%. And so that's nothing new. That's something that is being trying to be addressed, but it's mainly related to acquisition costs. Okay, if we move to the next slide, please. So here, see, we are looking at the decline in ROEs that we had mentioned in previous years. Now, there is an interesting reversal between 2018 and 2019 because of the impact of unrealized investment gains and losses. So, and one of these, one of the main drivers here, for example, can be, say, within this sample, we have the case of National Indemnity, which has a very large asset base. So in itself, it explains a swing of a loss, an unrealized loss of around $12 billion in 2018 to a unrealized gain in 2019 of 48 billion. So we have to be careful on how we look at this. But despite of that, so between 2015 and 2017, we have seen that decline. This is not just the result of underwriting performance. It's as well impacted by life business and by investment results for those large groups where these factors are important. Regarding the first half of this year, what we saw as well was significant volatility. You know, say we saw some cases where actually this had significant impact, especially during the first quarter. After that, we've had a significant recovery. How sustainable that is, it's still a big question mark. Say the rallying stock markets may simply reflect sort of a TINA, or there is no alternative effect. And especially in the case of indices like the S&P 500, it's heavily driven by big technology companies. So again, we don't know how sustainable that is. What we know is that volatility, especially in COVID times, is there to stay. Now, the big takeaway of this slide is that despite all these movements, and despite the contribution of last year, we have a 5-year average of 5.7% as return on equity, and this compares with weighted average cost of capital that we estimate between 7.5 or 8%. So definitely, say the issue of companies struggling to meet their cost of capital is nothing new. It's something that has been alleviated to a certain extent in recent times, but I believe is still an outstanding issue. Okay. Next slide, please. So here we have a similar picture, but for the 3 big subgroups. And again, as I had mentioned earlier, we can see these differences being exacerbated. On the one hand, the European Big Four, they have been able to generate positive return on equity even in the worst catastrophe years, 2017 and 2018. And I said the life component for some of these groups is significant. Say even with low interest rates, the large asset base that these groups benefit from contributes in terms of investment results, and that portfolio as well in terms of a steady pattern of earnings. We can see as well that the results of Lloyd's, for example, are exacerbated. The bad years, they look much worse than the other groups, but this is because of their capital structure. Say it's a market very much more capital efficient compared to the others, and that distorts and increases the volatility of the ROE indicators.
Just one thing to add on that, Carlos, in terms of that efficiency of the Lloyd's capital base, that there's one important factor, and this is a positive factor when we look at the rating of Lloyd's, that the ability to reload that capital and to reload it quickly. And already during the course of this year, we've seen Lloyd's entities having to raise capital to bring their capital positions into line with the regulatory process. So yeah, that's whilst it may have an efficient capital base, which normally equates to something that gives lower return on equity or higher return on equity because of a more efficient and therefore lower E in the ratio, and that ability to reload and to demand a reload is a key positive feature of the Lloyd's market.
Yeah, you're right. Definitely, say financial flexibility is a big plus in terms of that model. Okay, and next slide, please. So here we simply have a similar picture, but based on a 5-year average return on equity. Again, we show the impact of the positive reserve development, and this translates in between a 4% and 3% contribution to that ROE. So obviously the impact is mitigated because of life portfolio and investment returns, but say all in all, what we can see is that these returns, the trend has been showing clearly that say companies can't meet their cost of capital that easily. Again, this is not a new topic. It's something that has been there, and we had already factored into our market outlooks in the past. We believe that this is a significant indicator of pressures in the market to try to improve their underwriting discipline. So especially in a low interest rate environment, there is no other source of profits apart from actually improving that underwriting discipline. Okay, and that's what we have for this first section in terms of performance. I don't know if there are any comments, or should we move to the next section?
Yeah, thanks, Carlos. Let me address a couple of the questions that have come through, and encourage all of the audience to please keep sending us your questions at webinars@ambest.com. So definitely look forward to your questions, but let me kind of throw a few in before we transition to the next section. Here's question number 1. Reserve releases have been trending down over several years. Certainly, Carlos, that's something that you highlighted in the performance section of the presentation. The question is, do you think the sector will soon be reporting broad reserve deficiencies, more across the sector versus the one-off reporting of deficiencies we've seen so far?
I think that is a possibility. Say, let's remember, as I was mentioning earlier, what we are seeing is a net number. Say, behind it, we see different business segments with positives and negatives. It all depends on what the starting point is. Yeah, so definitely, in respect of previous years, there is still there's still room for reserve strengthening, and say the issues related to social inflation are still there. I think that the other possibility is that you could start with a very conservative reserving position, yeah, and there is room. For example, say we've heard about some companies thinking that the Japanese typhoons from last year, Hagibis and Faxai, have been over-reserved, and there is probably some fat there. Now, whether people think that, say, they are in a position to reserve that at this point, it's still an open question mark. But what I believe that it's in general, companies are trying to be more prudent, and the margin is going to tighten.
Okay. All right. Very good. Another question. I think this is one for you, Tony. What level of long-term ROE does the sector need to reach in order to get closer to its overall cost of capital?
Just to, as a reminder, that the numbers that we showed on cost of capital are in aggregate across the industry. And it is remind everybody that it is unique to every organization. Every one will have a different hurdles to cover for the cost of capital based on their organization structure. Another thing to consider is the low interest rate environment is a double-edged sword. One, obviously, from generating income, it's been a challenge, but the historic low interest rate environment does make the cost of borrowing money much cheaper. So as we look at across the board, although they haven't been achieving it lately, we do think the trajectory is on a positive momentum. But we do feel that the industry needs to be somewhere around that 7-8% on an aggregate to cover the industry from an industry basis. But each company obviously will have a different hurdle that they need to accomplish.
Yeah, and I suppose we would also see the trend and the 5-year average being probably an important metric there. We understand that the nature of reinsurance are going to be years where the pendulum swings to the better and also to the more challenging side in a heavy cat year or a year like we're experiencing in 2020. But it's that ability over time to reach that cost of capital, really, that's a metric that we focus on a fair amount at AM Best. Okay, thanks, Tony. One more question. 2019 was an average year in terms of natural catastrophes, yet only the U.S. Bermuda insurers were able to report an underwriting profit, tying back to that exhibit that Carlos walked us through. Greg, which lines of business would you say were the drivers of the underwriting losses reported in 2019?
Okay, Stefan, thanks. Well, I think if you looked at the numbers, we've presented some aggregate numbers for the industry, and what you see there is there's different underlying trends, either regionally but also by line of business. And whilst we were still showing some reserve releases overall, and I think somebody mentioned this earlier, for some lines of business we did see reserve strengthening through 2019. So I think particularly of US casualty and some of the specialty lines of business. And whilst probably during the course of 2019, we were already starting to see some impact of rate rises, they were relatively modest across the industry as a whole. So I think you're coming from a soft market, and the rate rises that had been seen across the market were not that dramatic. So we're not going to make it a bumper underwriting year anyway. So I think the relatively low or sort of average cat activity probably gave a pretty clear insight as to the true underwriting performance of the industry.
Okay, very good. Let's take one more question before we move on, and this is kind of coming back to our market segment outlook. In the slide with the headwinds and the tailwinds, under the tailwinds, flight to quality was mentioned. Can you elaborate a bit more specifically, because it's quite a broad statement? So maybe I'll take a crack at that one. What we mean by flight to quality is really the primary market saying, all right, I want to strengthen my reinsurance partnership with an organization that's really going to support me for the long term, right? I mean, alternative capital clearly has a role to play in the market, in the risk transfer, and a balance between traditional capital and perhaps that collateralized relationship that you get from third-party capital. There's a balance there that can be struck that could be very advantageous to the ceding company. But I think what we're seeing in the market today, the top 25, even beyond that, the leading global reinsurers that have the capability to provide a broad array of protections, a broad array of reinsurance solutions. We see the primary market players, many of them are looking for capital relief in this market, and that relationship with their reinsurance partners is strengthening as a primary form of capital relief for the primary insurance sector. So we do see panels reducing to some degree over a number of years, and it's not the need as it was years ago to have 20, 30 plus reinsurers on the panel. It's a lead reinsurer where you have a long-term partnership and understanding, and then rounding out that relationship with other players so there's not too much credit risk associated with reinsurance recoverables. But really, that's what we're talking about in terms of that flight to quality. And we're seeing that come through in terms of the top line growth and the ability of the leading reinsurers in the market to really pick the lines of business and the regions and the partnerships that they want to grow with, where they see some strong underwriting on the primary side. Other panelists, I don't know if you have anything else that you'd want to add to that.
Yes, probably a couple of things to add there. Say, first of all, is that flight to quality. Yes, we have seen it already. We'll illustrate that when we discuss the top 10 or the top 50, and when we look at the concentration of the market. Say, despite the fact that many cedants have been trying to look for diversification of their credit risk, those long-term relationships, that financial strength, the quality of results is important. The other point that I would like to mention is when we talk about the market outlook, these positives and negatives, we are not saying that they are going to affect every single company the same way. And we think that there are some companies that they are definitely much better positioned than others to take advantage of the improving market conditions. And these will depend on their business mix. This will depend on their legacy books, or on the quality and track record of their management and the market position as well.
Yeah, I think that's a good point, just to jump in real quick, because we have a stable outlook on the market segment, but based on current market conditions, there, from a rating standpoint, there may be players in the market that could see positive momentum from some of the things that we talked about. And based on exposure concentrations or maybe limited financial flexibility, there may be other players that are seeing more negative pressure. So it's not a one-for-one relationship. But Tony, I think you had something to add.
We have a slide later on that will elaborate over the last 10 years on the franchises, what has happened to them. And M&A activity has been partially driven by that flight to quality. Some companies are not able to compete in the marketplace, and they need to find a partner. And we'll talk about that a little more later on in the presentation.
Yeah, absolutely. All right, Carlos, why don't we hand it back to you to take us into the next section.
Thank you. Next slide, please. So now, looking at how dedicated capital is evolving, and these numbers are from a project that we have been working together with Guy Carpenter since 2012, trying to estimate both traditional and third-party capital dedicated to reinsurance activities. And we are well aware that there may be some discrepancies with other estimates which are much higher than this. And this is because we try to exclude capital in these large conglomerates, which may be actually spent to back primary insurance activities or investment activities. Like, for example, the case of Berkshire Hathaway, where, say, a significant part of their activities is exposed to investment risk. So that's one thing that I would like to clarify. So the other point is that in order to allocate capital in this way, we use heavily our proprietary capital model, and required capital is one of the drivers that we see in looking at these estimates. One of the points to mention here is probably, how capital has been increasing in recent years. I mentioned earlier that when we were keeping the market on a negative outlook, we were seeing this excess capacity. We still think that to a certain extent the market is overcapitalized, at least at this point in time. We saw as well over the years the significant influx from third-party capital. Now things are changing a bit recently. Between 2018 and 2019, we see a significant jump in that traditional bar, the blue bar. And this is mainly driven by investment gains, unrealized investment gains. Again, I think that earlier I mentioned the case of national indemnity. Say that swing actually explains about, say, 60 billion. Yeah, but for most groups, the direction was similar. So the magnitude wasn't that, but in aggregate, that explains that, that significant improvement. The other one is that we are seeing a reassessment from third-party capital. So between 2018 and 2019, we see a slight decline, and we're expecting that to continue, despite a recovery in the number of transactions that we have seen in the first half of this year, which are mainly driven by renewals of transactions, which instruments which were due to expire. The other point to mention is we see a slight decline in that blue bar between 2019 and our estimate for this year. And this is a combination of factors. It's not just the potential claims activity and reserving from COVID, but it's also management actions. Say, let's remember that, say, in the past, companies have been quite active in capital management actions in terms of special dividends or share buybacks. Some of those programs have been suspended or delayed. So what we have in that number is an estimate which actually shows the net effect of all those factors that I have just mentioned. But all in all, we still have third-party capital component, which continues to fluctuate between 18 and 20%. Despite seeing slight decline and this reassessment of priorities from third-party capital investors, we don't see a dramatic decline in terms of their participation. And obviously, the alignment of interests between traditional capital and third-party capital is still there. Okay, so with that, if we move to the next slide, please. See, I had mentioned the convergence between traditional and third-party capital. Let's remember in the early days, we had very strong margins on the ILS market, whereas actually the profits were eroding on the traditional market. What we have seen over the years is actually traditional players using the ILS market as a risk management tool to protect their balance sheets as well. And that explains, say, the alignment between both sectors, which we consider as a positive in terms of underwriting discipline. A point to mention here is, say, dedicated ILS managers, and say the number, say the proportion declined a bit between 2017 and 2018, and this was because of the fact that Nephila, which was within that bar, was acquired by Markel, and we'll see. So that shows, say, part of this alignment that I was referring to before. The other point to mention is that there is definitely a difference in terms of appetite, despite that slight decline that we are showing, difference of appetite between the large long-term institutional investors, which may still, say, the large pension funds, which may still see ILS as a relatively small percentage of their portfolio, and the more opportunistic short-term investors. And that dynamics is affecting this appetite as well. And in general, there is still some concern about the issues regarding trapped capital, which started with the significant cat loss activity in 2017. Say Irma was definitely the first proper test of the ILS capital markets. And at the moment, say something that had been estimated in 2018 at around 20% of trapped capital is expected at the moment to be around 15%. So out of this, say 89, 86 number, we should still expect around 15% of that number to represent trapped collateral, which say there where we're still, the market's still trying to find ways of making the use of it in a more efficient way. And we have seen some initiatives of securitization of, say, part of that capital, but it's still early days. Okay, can we move to the next slide, please? So here, and again, to illustrate that reduction in terms of ILS capacity, say we have here the red arrows. They show some reduction in funds from some of the players. So it is a bit of a mixed picture, but all in all, the net effect is a slight reduction. What we think is that, say, flight to quality is definitely playing a role here. So there are still, say, those funds with better track records being able to attract new capital. The other point to mention regarding the alignment of interests between third party and traditional capital, we can highlight here the fact that the two top players are Nephila and Renre Holdings, which are definitely closely aligned with traditional capital. Okay. Can we move to the next slide, please? So here we try to link not just the availability of capital that we have referred to in a previous slide, to the capital utilization. And this is again based on our proprietary capital model. So on the one hand, what we can see is the blue bar, which is showing the capital depletion needed to reach a 10% score, 10% capital ratio or excess capital at a 99.6% confidence level. Yeah, so this is the amount of capital that you would need to remove from the market to still keep a buffer of 10%. Yeah. And at the same time, when we discuss capital management initiatives with companies, what we see is that in most cases they target around 25% BCAR score, yeah, or capital buffer score, and it's based on this that we calculate that capital utilization. So this basically means that, let's say in 2017, out of the capital available for this universe of companies, 77% is what was needed to keep a 25% BCAR score. We can obviously see some trends there. Between 2018 and 2019, there has been a slight decline in that capital depletion needed, yeah, and an increase in capital utilization, meaning that the margin has shrunk a bit, Yeah, and this can be explained partly because of the investment gains that we had in 2019. So investment, say capital requirements for asset risk have increased proportionally faster than other components, and a few reserve strengthening actions as well. Say, at the time, say we were looking as well if, for example, catastrophe exposures would be a driver, but actually between 18 and 19, PML exposures look relatively flat. We expect this, however, to change slightly for this year, given the improving market conditions. Okay, and probably just to clarify, this is based on the top 50 companies that we have in the market, so it's a very good representative sample. Okay, next slide, please. So here I just wanted to make a quick reference to the top the top 10 ranking that we produce every year. So this is a subset of the top 50, which is part of the report that you can access later. Something to mention here is that we make a few adjustments to reflect the reinsurance business only. See, at the beginning of the presentation, I explained that there were a number of companies here which, being large conglomerates, may have some primary business as well. The other point to highlight is that we try to exclude from here intragroup business. Yeah, so this is only third-party business. Swiss Re, for the third time in the last 4 years, is in the top position, and the margin has actually widened. Let's bear in mind, say, Swiss Re still keeps a material primary business in corporate solutions, but being less than 25%, say we keep that in these numbers. In the case of Munich Re, we have a significant primary business in shape of Ergo, which is excluded. Yeah, and this is because we established that threshold of 25% to determine whether the business could be significant or not, and we exclude or include that in the numbers. The top 10 has remained relatively stable over the years. Probably the only thing to highlight here is the inclusion of Partner Re, which comes back to this top 10 after a few years and after a 15% growth during 2019. Next slide, please. We have a similar picture here, but splitting the list between non-life and life. Yeah, so first of all, we have excluded some regional groups, so we have only groups that we consider global with an international presence. So, and what we can see is that a number of companies are in both lists because they have a composite model. Yeah, but in the case of the global reinsurance groups on non-life, for example, we bring here to the list groups like Everest, XL, AXA, and TransRe. In the case of the list for life, again, we have some exclusive life reinsurers like RGA, or we include groups which have a significant life component, more important than the non-life component on the reinsurance side, such as Generali. And again, these groups have remained relatively stable over the years. Okay, next slide, please. So here, simply to illustrate the reference that we had made earlier about flight to quality. Yeah, so the concentration, I wouldn't say that this has changed a lot. In any case, the top tiers are the ones which have been increasing slightly, and this has been the result of consolidation over a number of years. So the top 10 still represent about 70% of the market based on gross premiums written. If there is any room for loss for M&A activity, I think that will happen between the second and third tiers. And in the smaller ones, what we have is a number of regional or national players, which again, we think that there's always a place for them given their specialization in particular markets, the size may be more suitable for particular sedans as well. So I wouldn't expect a significant change of this over time.
So Carlos, just to add one point on that, I actually look back at the 2016 distribution of this pie chart, and we talk about this being pretty stable, and indeed it is. If you go back to 2016, then the top 10 actually had a slightly bigger market share than they do today. They were just over 70%. But the area that's grown most actually has been the 11 to 20 ranking, which was only about 13% back in 2016. Sorry. But what that masks is that consolidation. I think Tony's already alluded to the slide we're going to come to in a little while. That apparent stability doesn't necessarily fully pick up the consolidation that's gone on there. So we'll come back to that.
Thank you. Next slide, please. Yeah, Tony had referred to this slide, and here we simply say, first of all, this is not an exhaustive list, but we are trying to illustrate what has been happening in the last 10 to 12 years. Say, first of all, we have on the first pillar, say, a number of companies, what we are calling the surviving franchises of today. Say, several of these are in the top 10. They are very well established groups with a long history. Where we had seen quite a lot of movement in past years have been the sheltered franchises. So companies which used to be independent, say listed or privately owned, they were acquired by a larger group and sheltered in this way. And say we have the likes of Odyssey and Allied World in the Fairfax Group, or Gen Re and National Indemnity as part of Berkshire Hathaway. The ones that are gone, and the evolving franchises. And what I would say is, say in terms of room for any additional movements, probably the market is already quite consolidated. I don't know if we can keep seeing that movement from the first to the second pillar. Obviously, we can always expect new companies which go through all this process. The only thing that probably I should point out is that within these evolving franchises, we see a number of the so-called hedge fund REITs or total return reinsurers, which are still in a startup phase, and they are facing some challenges. So investment volatility, given their investment strategies, has been a bit disappointing, say significant. Some companies are trying to re-evaluate these investment strategies and re-evaluate their models themselves. There have been some changes in top management. So I think that this is an evolving space. And probably something else to mention there is only the announced transaction between Third Point and Sirius that is still evolving. I don't know if there are any additional comments about this slide, or
you know, they're going through a metamorphosis. They've come through a business plan. Some of them have worked. Other ones, as we've all seen, are in the news as far as transactions But they're changing, and that's what a business plan is. If you look at Hamilton, they were going down one path, and just recently they acquired and came into an acquisition of Pembroke. They're changing the business model, refining it. Third Point Sirius has been around for 75 years and has an established track record. Third Point, maybe a little trouble with their getting market momentum, getting more of just being a follower in the marketplace. They're coming together. So they're evolving. Is not to say one is better than the other, but it is something that's going to morph over time into different avenues as these programs decide which way they want to go.
Yeah. Good. Okay. Next slide, please. Yeah, I think that this is an interesting slide. So here we are trying to show the trends of price to book value, and I think that over the long term, this chart seems to suggest a close relationship between this price to book value and the market cycle. So in particular, if we look at years such as 2002 or 2007, say points where price to book value were above average, say were points of a hard or relatively hard market cycle. And again, when we were looking at this last year, we saw this slowly increasing trend, which may have suggested, say, the early signs of a hardening market. Say, obviously, 2012 becomes a very difficult year to read because of the volatility of the stock markets. And that is something that can be seen in the chart as well in 2008. So there's some noise there from market volatility. So we don't know how much representative that final segment in 2020 is. Something interesting to note is that if we look at more recent transactions, say we start seeing price to book value actually going up. Say if we think of the failed transaction between Covéa and Partner Re, that would have meant a 38% premium on book value. Yeah. After that, say that was pre-COVID. Yeah. So during COVID, what we have is the Third Point Sirius transaction implies a 0.8 times book value price. And say we were aware of, say there were some reports in the press last week, yeah, about Watford and Arch, which haven't been confirmed by either party, but that would have implied a 0.62 times book value. So again, say it's difficult to analyze, say what the latest figures mean, but in general, when we look at the long-term trends, definitely we think that this is a very good indicator of where the market is going. Okay. Next one, please, and I believe that's the last one in this section about capital. So this illustrates how the pricing has been evolving in the ILS markets, in particular in catastrophe bonds. And let's try to read this chart with a bit of patience. Say we have, on the one hand, we have the expected losses, which are reported for the transactions in each year, and the spread reflecting the required return by investors. And the way we measure the pricing is by the loss multiple, or the times that spread represents compared to the expected loss. And what we can see is that between 2013 and 2017, there is a significant decline on that loss multiple. So it started at 3.47. So that's the box at the bottom of each bar. And it goes up to a low level of 2.06 times in 2017. Obviously, that's just before the Harvey, Irma, Maria. And after that, it starts to go up again. By the first half of 2020, we have that multiple getting back to the same levels of 2014. Yeah. So that is interesting, and that shows the same shape that later we'll see has been happening in terms of rate on line, with the only difference that rate on line hasn't gone back yet to the same levels that they had in 2014. Now, let's remember the drivers. Between 2017 and 2018, we had around 1.7 billion of cat bond defaults, and that's almost double than the 1 billion that we had had in the previous 21 years. Yeah. So as I said, this has been driven by not just the hurricanes, but wildfires and Japanese typhoon activity. So issues related to loss creep, restatement of reserves several times, and especially trapped capital, collateral, which can be released because we have this long tail associated to catastrophes, which wasn't expected previously, is having an impact on the appetite from third capital investors. And what we believe is, we don't think that this is necessarily going to disappear. That capacity is still there. We see lots of capital on the sidelines waiting for new opportunities, but investors are becoming much more selective. They are taking their time. Uncertainty is an issue. Yeah. Trust or in the robustness of CAD modeling is something that is being put into question. So there are, so I said, we don't expect a dramatic decline on this, but there is definitely a reassessment of risk appetite.
And Carlos, just to follow up on that, earlier we spoke about the flight to capital on the ceded side. And I think that's very evident here in third-party capital as well. They're looking for themselves to align themselves with strong underwriters. We see that which third-party capitals and which insurance organizations are getting together. So that flight to quality is prevalent both on the ceding as well as third-party side.
Okay. Do we have any other comments or questions, or should I move to the last section?
Yeah, why don't we spend a couple minutes on some questions that have come through? And I think Tony's point on that flight to quality is a very relevant one. And when we speak of alternative capital, there's also a flight to quality on that front as well. Not all ILS managers are here today that were competing in the market a few years ago, and there's definitely an appreciation for that partnership in terms of alternative capital as well as traditional. And some of the evolving franchises that we saw on a previous slide there are some very well-established players providing risk transfer on a collateralized and more recently on a rated paper basis. And we feel that there's definitely an aspect of the flight to quality on that non-traditional side of the equation as well. But to hit a couple of questions, let's go back to the overall capital in the reinsurance sector. And our prediction for 2020 full year is a decline, kind of a modest decline in that overall capital backing the market. Tony, is that really more due to COVID-19 related losses? I know that Carlos mentioned some companies are halting share buybacks and special dividends. So what's really driving that expected decline in capital?
Well, COVID has a lot of tentacles, and before I try to address it, we have to remember this is an historical event that none of us have lived through. And unfortunately, there's been a substantial loss of life throughout the world. And unfortunately, there's going to be some more loss of life. But when you look at the COVID situation, the ramifications or the tentacles go very wide. You have the loss accumulation coming, if it's event, if it's BI, whatever the case may be. But you also have you had and still dealing with a global shutdown where the economies have been stymied by the lack of movement and the deterioration in fundamentals. So COVID is driving a lot of things, but it's hard to separate that it's not the low interest rate environment, it's not the inflation. There are substantial catastrophes that have happened throughout the world, and right now we've got a hurricane that's headed towards Bermuda, and I think there are 4 other tropical storms in the North Atlantic and some out in the Pacific that are going. So COVID is a backdrop, and it's a significant part of deterioration of capital, and the ramifications or the tentacles are going across the board. So we do see some deterioration projecting for year end. Now, if some of these storms material to much significant events, there may be a little more, but we started with a balance sheet on the reinsurance segment that was fortified, that was very strong and robust. So even if there is some deterioration in year-end surplus or capital, it's not material, and it's not going to be a driver into any ratings, any impacts on ratings.
Yeah. All right. So for the sake of time, let's hit on one more question that's come through, and then we'll move over to the final section of the presentation. Carlos just showed us the trend of improving margins in terms of the relationship with the expected loss on ILS. But even with those improving margins and improving conditions, the amount of third-party capital appears to be on the decline. Greg, can you speak to the reasons for that?
Yes, certainly. I think Carlos early in the presentation gave a very good overview of some of the factors, the dynamics driving that market, but probably just a couple of other points to sort of pick up on. I think alternative capital was seen as a mechanism for people to enter and leave the reinsurance market on a quick and easy basis, and to bring that sort of real liquidity of capital into the market. And then the trends of recent years with capital or collateral being tracked, I think has probably caused investors to look again at just whether it does really bring some of those benefits it was supposed to bring. I think there's also another issue in terms of the correlation. It was seen by many investors as a non-correlating asset compared to other asset classes. That there seems to be a bit of a breakdown in that non-correlation in recent months. So perhaps it's not providing the diversification benefits that was originally seen. And I think there's probably one other factor as well to think about, and that is, if you go back to the basis, the premise of it being the types of risks that could be easily modelled, and therefore structures could be built around clearly indicating loss triggers. Well, that requires a sort of a large pool of risks that can be quite easily indexed or measured in that way, and there's a limit to business that goes into the reinsurance sector that qualifies really for being suitable risks to back that type of structure. So I think there's probably a natural limit to the size of the alternative capital market in terms of the risks that could be supported by those structures. And we may not be at saturation point, but it may be that expanding it further to to cover broader risks is something that you know, they're not the easy wins. So it'll be perhaps a longer time before we see that movement.
Okay, very good. Thanks, Greg. All right, Carlos, back to you for the final section.
Okay, thank you. Mindful of time, I'll try to run through this last section relatively quickly so that we may have some time for questions towards the end. So next slide, please. So this just illustrates what we were saying earlier. Say rates on lines, they show a similar shape as those loss multiples that we saw in the previous slide. So declines between 2014, 2017. So softening markets and slight increases going forward. This, it's interesting, this goes hand by hand with the third-party capital availability. What is the big question mark is what's going to happen going forward. And again, the main difference, I believe, compared to previous hard markets is that, say, previous hard markets were driven by erosion of capital. So in this case, there is plenty of capital around. It's just lack of investment opportunities, uncertainty, and the drivers are mainly around underperformance. So one of the big questions that we have is how sustainable this hard market can be. So we believe that we need at least a couple of years to try to compensate for losses from previous years. And there is still the risk of capital elasticity. So pricing conditions getting to a point when the market gets flooded again. So hopefully that won't happen anytime soon, but only time will tell. Next slide, please. Say what are the lessons that we have learned so far? Say it's catastrophe losses do have reserve tails, so trapped capital is an issue, and this affects both ILS markets and traditional markets as well. Say we had Harvey, Irma, Maria. They tested the ILS market for the first time. Yeah, so before then, it was easy to believe in the precision and the robustness of CAD modeling, say, as there were no defaults. So obviously, once this happened, we've had a number of factors around trapped capital and the tail in reserving. Say some of them have been associated to capacity, resources limited. In the case of Harvey, Irma, Maria, we had 3 hurricanes happening in a very short period of time. We've had explanations even around loss adjusters, say not being available or lack of knowledge in Puerto Rico, for example. Yeah, say legislation like assignment of benefits affecting Florida claims. Say similar case with Japanese typhoons. Again, resources tied up because of the Olympics. So there are different explanations that we can put around this, but the truth of the matter is that those 3 elements, say one, the loss creep, second, trapped capital, and third, what Greg was mentioning, the apparent or the questioned now lack of correlation between these risks and the rest of the economy is something that is changing the perception of risk and the investor appetite. Okay, next slide, please. Say COVID is still an ongoing event. The range of estimates is very wide. Say we have Swiss Re suggesting between 50 and 80 billion, Lloyd's more than $100 billion, Munich Re between 30 and 100 billion. Say at the moment, both for the insurance and the reinsurance industry, we have reported claims of around 25 billion, which is sort of half the lower end of the estimates. So it's still, if we stick to those numbers, it's still equivalent to a significant natural catastrophe. Yeah. The impact on loss ratio, as I had mentioned earlier, is between 5 and 20%. But the main thing is that it is still an ongoing event. There are a number of issues which haven't been resolved. Say most of the claims are IBNR, so they are very rough estimates of how companies may be impacted. In respect of business interruption, after an initial period when most companies were dismissing the impact, let's remember at the beginning of the pandemic, say the idea was, say, as long as there is no property damage, business interruption shouldn't be an issue. Now, especially outside the US, we have different interpretations. In the UK, in particular, we're expecting the FCI test case resolution next week. Let's see how much of a resolution it is, or it simply opens the field for more questions and challenges. But most importantly, it is an event which has challenged several assumptions. Say until now, most of the modeling, for example, was focused on life risks. Now what we can see is nobody could predicted the level of widespread government intervention. So the impact on non-life is actually much more significant than the impact on life, and we just can't see the results for several composite groups. And the other thing is the other significant assumption that is being challenged is the correlation with the rest of the economy. So on the one hand, both life and non-life seem to a certain extent correlated, and the insurance and reinsurance industry seems again, say, correlated with the rest of the economy. Next slide, please. So all in all, the factors that have been putting pressure on underwriting discipline remain. Say we're still in a low interest rate environment, and to this we are adding recessionary pressures related to COVID. Say the prior year's reserve releases continue to decline, and we're seeing it's probably companies will have to increase their margins of prudence. Say even if there is some cushion there, I doubt that we'll see a reversal in trends. We have the reassessment by third-party capital providers, and let's watch this space, and the added claims uncertainty, not just from COVID, but from catastrophe risks, which are becoming much more frequent. Say we are talking about wildfire cases, for example, which say if we look at the last 40 years, 70% of claims have occurred only between 2017 and 2018. Yeah, so what we are seeing at the moment, and it's still early days, say the losses are estimated to be around the range of 12 and 13 billion for California wildfires, say around the same magnitude that we saw in 17 and in 18. So, and we have the issues related to social inflation. So the nature of risks is changing, and it's becoming much more difficult to model, to predict, to price. So finally, just a few words, and the next slide, please. Just a few words about the challenges and the opportunities that the reinsurance industry faces. Say, I included there a few quotes from top executives in the industry, emphasizing the role that the industry should play from a socioeconomic point of view. And this is nothing new, but it's definitely something that is being highlighted in these times, in this COVID pandemic situation. I think that all the discussions about business interruption actually are highlighting the issues related to the protection gap. So even in the worst years of property catastrophe losses, 17, 18, when we look at the protection gap, insured losses represented below 40% of economic losses. So we think that when these things happen, when risks continue changing and they are difficult to price, the first reaction can be to, say, increase the level of prudence, decline limit covers, exit certain lines of business. The problem with that, and definitely the challenge, is to what extent you stop that and the risk of becoming irrelevant for the rest of the economy. Yeah, so we are aware of recent discussions about, for example, the role that the industry could play for future pandemics. Say, we've heard at the beginning of last week, say, Munich Re apparently is supporting the idea of some national pools with certain conditions. We believe that, say, any role, say, in a situation like this is challenging because of the systemic nature of the risk. So risks which can't be diversified, which affect all lines and geographies at the same time. And the private sector on its own is unable to absorb all the costs. But there might be a role in terms of partnerships with governments, in terms of facilitators, advisors, which may still highlight the contribution in terms of expertise and, say, infrastructure that the industry can provide to contribute to manage these risks for the benefit of society in general. And with that, I would like to conclude. I think that at the end, we have simply a summary of the headwinds and tailwinds which reflect the rationale behind our stable outlook on the global reinsurance industry. Thank you very much.
All right, thank you, Carlos. I appreciate all of the good questions, and apologize to those of you whose questions we were not able to address in the time allocated today, but I am afraid we're pretty much out of time. So with that, I'll hand it back to Nick.
Thank you, Stefan, and thank you to all our presenters and panelists, particularly Carlos, for taking us through the presentation. If I could just have the next slide. And the one after that. Yeah, just to mention a few final housekeeping points. The playback of this webinar will be available within a day or so. So obviously, if you want to listen to us again, you're free to do so, but more importantly, perhaps refer it to some of your colleagues. We have some other events coming up, virtual events, well, one later in the month, which is a similar reinsurance briefing with a particular focus on the continental European market on September the 22nd. That's in place for our normal event in Zurich. And our London event will also be virtual. That'll be on November the 11th. One event that isn't on there is next year's Monte Carlo, but rest assured, we do have the Salon Eiffel booked at the Hermitage Hotel. I think it's on September the 12th at 10:15, and we very much hope, well, I'm sure we all hope we can be there, and we will obviously hope to see you there. With that, I'll just thank you for your attendance. I can see that we've managed to keep most people on for most of the time, but thank you very much for your attendance, and do enjoy the rest of your weekend. If for those of you who are having a virtual Monte Carlo next week, do have a good week. And with that, I'll close this webinar. Thank you.